Good evening, everybody, and welcome to the next episode of On the Move with myself, Rich Checkan, and Adrian Day, my co-host, my esteemed co-host. We've got a fantastic program today. We're going to cover everything from the macro to the micro. And everything in between. And we've got the perfect guest to do that. But I'll let Adrian introduce him. First, I just want to introduce my colleague here, Adrian Day. I think you all know him, so I'm not going to go deep into it. But born in England, London School of Economics, graduate with honors, I believe. Or am I throwing that in, making that up?
No, that's okay.
Yes. And of course, he's been a newsletter writer, best-selling author. He's looked after on all these talk shows for his interviews and his insights. He's an esteemed fund manager for the Euro Pacific Gold Fund, and he's runs an asset management firm. That's how I initially got to know Adrian so many years ago, through his work there, which has been incredible. And always great to be with you, and looking forward to tonight's conversation, Adrian.
Well, thank you, Rich, very much. And I'll just say a few words about Rich. I've known Rich for maybe 30 years now. I knew his uncle, who was the founder of ASI, even longer. Rich is the president and COO of Asset Strategies, which is a bullion and coin dealer, gold dealer. Highly recommended. And I've known Rich for a long time. And if you deal with Rich, you will definitely be in very, very good hands. Our guest tonight, let me move right to our guest, if I may. I've known Peter Cavelti since the 80s, early 80s, which is a long time, right? And we've done several things together. We sat on a gold mutual fund board at one point, and we also did a little tour for the Canadian Mint when they introduced the gold maple leaf, and you were instrumental, Peter, in introducing the gold maple leaf. So maybe we'll get to that later. But Peter, I know some people maybe don't know Peter, and you're missing out. But Peter is a fund manager, manages some accounts, has a newsletter, and is also an author. And his books include not just investment books, but non-investment books, including fiction. So a real and a great skier. So a great Renaissance man, a genuine Renaissance man. I'm very, very pleased to introduce Peter Cavelti.
Thank you, Adrian. And yes, you've just evoked some valuable memories about times.
Yeah, well, yeah. And maybe some more as we go through. So let's kick it off, if I may, with a very, very broad question, just to set the scene, to see how you're thinking about things right now. So what do you see as, let's say, the top 5 macro themes that will affect markets now and going forward?
Yeah, that's a great question. And actually, there are 5 macro themes. I seem to deal in 5s whenever it comes to analysis. The first one is geopolitics, obviously. And I don't mean by that geopolitics just in a military strategic way. I'm thinking of geopolitics as the reality that has dominated the world since the end of World War II, which left in charge of, de facto charge of the IMF, the World Bank, NATO, the world's reserve currency, 3 out of 5 veto seats on the UN Security Council, and so on. I call that the post-war order. And of course, the United States calls it the international rule-based order. And my Asian, Latin American, and European friends always chuckle at that, and they say, we know whose rules those are, right? So that US dominant world is really being challenged as the world asks itself, is the US capable of continuing to lead militarily, economically, and all that? And so geopolitics is in a huge transition, and the US is strategically in a position of overreach. We see that live right now. The US engaged very actively in Ukraine, and all of a sudden Gaza pops up. And all along, the United States is telling the world that the real thing we need to do is to contain the rivalry with China. This will make for an explosive situation. Let's not forget that the United States has 751 military bases in 46 countries. And if overreach ever required a definition, this is it. So we're going to get some sparks there, and that'll affect all markets. The second macro theme I see is the changing social dynamic. We've been since the 1970s in a society in which consumption was promoted above all other things, became an ever larger component of economic activity by design. And now we're in a state where simultaneously the consumer is maxed out, is really feeling the pain. And the consumer is also realizing that the political charades that he's been served up with, the Republican Democrat way of thinking, the gulf, the polarization, all of a sudden, I think society is realizing that maybe there is more to that picture than two parties. And I hear the term uniparty being bandied around more and more often in the United States. And I think government has very ably exposed itself as a manipulator, particularly during the last 3 or 4 years. And people are getting that all of a sudden. So I see some changes there. I don't know how that'll manifest, but again, it'll definitely affect things like consumption and behavior by society. A big part of what consumers experience, but also is an ever presence in the corporate world and above all in government, is the third macro theme, which is the recklessly acquired debt and unsustainable debt that exists at all levels. And that is already very, very visible in markets. We have all kinds of manifestations in that in the bond market, in different sectors of the stock market. It's another reason why things like gold are doing well. And that, of course, will lead to the fourth macro factor, which is the emergence, indisputable emergence of stagflation. I mean, the economists around the world are engaged in this debate. 3 rate cuts, 2 rate cuts, maybe only 1, maybe higher for longer. All this to me is just a bunch of nonsense. What is really underneath is that whatever we do to get that debt spiral under control is going to be so painful that government is, in my opinion, highly likely to just reverse course and encourage the reemergence of inflation at a higher level than we just experienced a few months ago, and the presence of stagflation. It reminds me very, very much of the 1970s. And then the final and potentially, this is not smaller than any of the others. This shouldn't be in 5th place. It might be.
I was going to ask about an order here in a second.
Is the BRICS and the Shanghai Cooperation Organization. You have a situation that's basically being evoked by the United States, where now everybody can see in crystal clear way that getting on the wrong side of the United States is extremely painful. It saddles you with sanctions, and what we just saw a few days ago when Congress authorized the administration to freeze, at their behest, foreign exchange reserves of Russia. And in the eyes of the other BRICS members and formerly unaligned and aligned nations, that might happen to them, is that the reserves that they had in places friendly to the United States might basically be stolen. This is grand theft. This is not a sanction. This is pure theft. And this is going, in my opinion, to drive further the quest to disengage from links with the United States from the dollar, from using US payments and trade settlement platforms, and so on. And that, again, is going to have a massive impact on all asset classes. So those are the big five. And, they're all dramatic. And the reason is really that on all those fronts, we've been going in the wrong direction for decades. And you could mention agriculture, education, healthcare, all kinds of policy platforms. When you go in an unsustainable direction for 3, 4, 5 decades, the reckoning becomes much, much larger, much more painful. And this is what lies ahead, in my opinion. And it's going to be a tough slug. Yeah.
Well, we could spend all day, all night over a good bottle of wine discussing any one of those. Just if I may, Rich, I'm sorry, just if I may, looking at the last thing you mentioned, I'm acutely aware of some of the things you were talking about, but one of the things that often occurs to me as a Brit is, there's no question that Britain was the world's leading economic, political, and military power for most of the 19th century. And then it started to fall apart in 1914. And then eventually in 1945, of course, Britain was indebted, overextended, all the things you've said about how the US is now. But the point I wanted to come to is in 1945, it was very, very, very obvious to everyone in Britain, however much we didn't like it, but it was obvious that Britain was no longer top dog. And it was obvious that the US was top dog. And thank goodness the US and Britain, for at least 100, 200 years anyway, had been on the same side. And America had obviously just helped Britain and Europe out in the Second World War and then before that, the First World War. So the point I'm making is the transition of the world's reserve currency and the leading economic, military, and political power from Britain to the US was a pretty smooth transition, other than Suez, of course. But it was a very smooth transition, and Britain was not fighting and kicking its heels to stop it. I don't see any acknowledgement among US people that they are going to lose their dominance in the world. I don't see that recognition, and I certainly don't see a smooth, peaceful transition, if such a transition comes, from the US to China at any time in the foreseeable future. So the question, I'm sorry, how do you see all this playing out? What are the potentials?
Well, that's fascinating, Adrian, and I've thought about the British precedent many, many times, and this will be very different, I agree. It's also a fact that this may take much longer than some people realize. Transitions like that play out over time. And right now, when I look at the BRICS, I have to say there are some members that have been there from the beginning, like India, for example, who are playing both sides. There's no question on my mind. Saudi Arabia joined recently. They're playing both sides. They're very transactional. So that may stop may stop the pace or slow down the pace that we all envision about the BRICS evolution. We heard a lot of headlines. We heard that they're going to have a gold-backed or commodity-backed currency any moment. These things take time. But I think what is happening is, and I imagine our discussion will later turn to gold as well, and it's evident there, what is happening is the centers of action are shifting. All of a sudden, the GDP, combined GDP of BRICS and Shanghai Group GDP is larger than that of what used to be the developed economies. All of a sudden. And that's when you look at the growth rate, which is the fastest growing economy in the world right now, India, of the majors, right? At basically 3 to 4 times the speed that the Western nations are growing. And so that momentum is going to accelerate. And the sanctions since the beginning of the Ukraine conflict that have been introduced are frightening off every corporate leader, every government leader in the rest of the world, including some nations that were strong allies of the United States. I mean, look at Canada. We were basically told by President Trump that we were a national security threat when he slapped sanctions on steel and iron ore tariffs, iron ore exports to the United States out of the blue in contravention of the agreements that existed at the time. And in the US, as you say, there is no sign that most of Americans understand. They kind of feel that this is happening, but the willingness to submit to a transition, in my opinion, should not exist and does not exist. And it was really a fluke with the British-US confluence. And really, at the beginning of World War II, the US entered the war with a very isolationist theme. And it took all of Winston Churchill's effort to convince FDR to join the fray, right? But that was really a transitional moment that was very effective and facilitated the changing of the guards.
Sure.
Yeah, I can't
And I'll
argue
also
with
point out, if I may, that it was land lease, remember. It was America lent the money to Britain. They didn't shovel money at us as America is now doing with Ukraine, but that's a different issue.
Yeah.
And that's not to say we're not grateful. Oh, I should be pointing at Rich.
No, if I can kind of work back, we're talking about the BRICS, just quick comments on all this stuff. I can't argue with any of it, Peter. The BRICS, I'm with you 100%. I've said this before that, really a problem weaponizing the dollar. It's really a problem. It's not just pushing our enemies away, it is pushing our friends away. And we're forcing friends to play both sides, go make alliances with the BRICS and others, look for ways to trade outside of the dollar, et cetera. I'm sure it's a lot of what is driving all the central bank gold sales. Adrian, you wrote in your recent Global Analyst how we're on pace to surpass last year, which was only 4% shy of the previous year's central bank gold sales. We are doing that. We're making central banks shed dollars for gold, which is also a tier one asset. The emergence of stagflation. I don't know what kind of glasses we all have. They must be special, because Jerome Powell said just last week that he doesn't see the stag or the flation. And I don't even want to go too far into that, other than previously in the Q&A, he said that he can't lower interest rates because we have too high of an inflation, but we don't have any inflation. I don't even want to go there. But we're heading to stagflation. I agree with you. The reckless debt. I mean, people that say debt doesn't matter have no clue as to where this is going. The social dynamics, the geopolitics. You can't fight a two-front war, let alone a three-front war, and that's what we're setting up for. My military background suggests it's a bad idea. So yeah, I'm with you on all these points. There's no question about it. They are going to have an impact going forward. So I know you want to add anything to that, Adrian, or?
No. Did you have the next question, or?
Yeah, and that's where I was going to go. Looking back historically, I know you're a student of history, Peter, right? So do you see any other comparable periods in that post-war history where, the U.S. has kind of emerged on the scene? Do we see any other periods that are similar to what you're seeing right now?
Well, I think, the current situation in some ways is very reminiscent of the 1970s, in the sense that the central bank in the United States, the Fed, basically threw caution to the wind, and everything became very inflationary. And the difference then, in many ways, and now, is back then you had several strong currencies. You had the German mark, the Japanese yen, the Swiss franc. Well, where are they now? You could argue that the Swiss franc is a little healthier than most of the others, but basically the kind of reckless behavior by central banks, often triggered by even more reckless behavior on the fiscal side by governments, You know, I mean, the
What's
central
driving
banks are
that
always the
train?
ones
Yeah.
that are being blamed. And really, when you have government spending money, uh, oceans of like creating oceans of you know, just spending, and then the central bank, this comes on the back of the central bank having created oceans of liquidity beforehand. Then you put the central bank into an impossible situation. Part of it its own making, part of it the government's making. But basically in the 70s, the difference is you had strong currencies and you had the weak dollar. And, you know, I remember there was that thought, much as exists right now, with the predominance militarily, like everything in the world, you know, in the Five Eyes economies, in the European Union, in Japan, and other allies. The United States sets the tone. The United States initiates the tactical and strategic visions in each conflict. And that is really quite interesting because when I was a young foreign exchange trader in the early 70s, I thought that when Nixon disbanded the Smithsonian Agreement and cut the dollar, the gold backing off the dollar, I said to all my colleagues over and over, any moment now the dollar is going to crash. And the belief system back then was, oh, you don't know what you're talking about. You're from Switzerland, you know. The US won the war. The dollar will always be the premier currency in the world. And then 5 years later, you know, the French and the Germans and others started trading their dollars for gold. They replaced them with gold, much as China is doing right now. And then the dollar started wobbling and it got very weak and gold went through the roof. Then Paul Volcker came in, and this is where I think we will not see a repeat. Volcker came in because the consequences economically, if we did today what he did then, would be absolutely devastating. We would not have a big recession. We'd have a depression.
Yeah, I don't think most people realize that, Peter. I mean, they say, well, you know, they could just raise interest rates. Well, they can't. We
No.
have 6.6 trillion in debt.
Yeah,
Volcker started with 400 billion. He ended with 800 billion.
yeah,
It's a big difference per
yeah.
interest rate increase on the service on that debt. We cannot manage that. That's a big difference between now and the 70s. 100% agree.
Yeah, you're talking $1 trillion every 100 days. Seems to be the pace right now. And
Right.
you know, and the other thing is that the government is it's not just the Fed again, it's the fiscal side. The government is absolutely uh, dependent on selling bonds. And so, you know, the interest rate on those bonds will go to the heavens.
Who's going to buy bonds of a
And who is
weaponized
going to buy the
currency?
bonds? Exactly. Yeah.
Right. Right. So Peter, then tell us how should an investor protect himself? You know, how should we put our investments to work in this environment?
I think the great imperative to me, and a lot of money managers would disagree with that. The economists would all disagree with that. To me, the most important tenet is not to buy anybody else's liabilities. So that means you cannot buy bonds. And you know, a bond is a promise of repayment, and compensating for that promise, you get interest on it. And I could go through monetary history and name things where governments took haircuts off bonds, off their bond liabilities, where governments defaulted. It's happened numerous times around the world, and it can happen here. You could have a totally different thing. You could have the US enter into a state of direct enmity with China, and the US could, in the same example as they just did with Russia, say, we're not honoring the promises we made to you because you're an enemy now. And the Chinese are recognizing that is why very much they're not present at bond auctions. They're liquidating bonds and they're buying gold. I would too if I were them. And so, you know, how can you safeguard in this? So number one, don't buy other people's liabilities. Much better to buy stocks in certain sectors, much better to buy commodities. I would argue it's even better to buy real estate. Everything is better than somebody else's liability. So you want to be the owner, not the creditor. And the second thing is, I say you can only safeguard your assets in a proper way if you divorce yourself from dogma and confirmation bias, and you accept that the outcome is impossible to predict. Again, we've for decades gone in the wrong direction, and all kinds of things are going to start affecting each other. Different swans are going to pop up, and one will affect one asset class under duress will affect another asset class. So you've got to be very, very agile, very proactive, and very quality oriented. So, for example, in the stock market, I would not touch anything that doesn't have a strong balance sheet. I just wouldn't. I might miss a lot of opportunities short term, but I think that's where one problem is going to be. I would not buy any company that doesn't have an established moat around its business model and generates sustainable cash flow. That's equally important.
Can you explain what you mean by moat? Some people might not understand that.
Oh, just you know, the old castles in the medieval times had a moat around them, a trench around them filled with water usually, so nobody could get across once you drew up the bridge, right? So, for example, if you take a pipeline company that has a strong presence in a given market, that would be a typical example of a company with a moat. Somebody else can't just come along and build another pipeline on the same territory and hope to be successful. And so that's a good example.
It could be sufficient patents, things of this nature as well,
Yeah,
something to protect your unique selling proposition.
Yeah, like, you know, I don't recommend or dissuade, but if you take a corporation like IBM, unlike some of the more contemporary tech models, IBM owns so many patents. It's going to be around for a long, long time. That's a company with a moat, just as an example.
Right.
And if that company can also pay a decent dividend, that's even better. So we're very selective with stock selections. We also like companies that are backed up by, that own assets in the ground, physical assets that are producers of raw materials. And, you know, I'm sure we'll end up talking about commodities anyway, because it's a really interesting space right now, and they seem to be gaining rapidly, a number of them. So that's kind of how I would protect. And then always, I have, when I'm not sure what the outcome is, I have a decent cash position in my portfolio. And right now, it's very hard to argue with a cash position when you can make with a CD ladder something like 5.5% a year. That's a fantastic return. And I also always have a position in, guess what? The background to Rich's portrait there.
I think
gold.
some of this is yours behind you.
Right. Because why gold in that context? And not just because it's of its commodity fundamentals, not just because it bests all other currencies, which are becoming increasingly worthless, but also because it's such a potent portfolio stabilizer. And I've done a lot of research on gold over decades, and we've come to the conclusion that somewhere between 15 and 12% of a portfolio in gold gives you the best, historically, the best chance, the best crack at being a potent stabilizer. You know, a counterweight to whatever in your portfolio goes down.
Gotcha.
And you're talking physical gold, not the equities.
Here I'm talking physical gold.
Yeah.
And during appropriate times when the trade looks good, we might add some gold stocks, but that's not part of the portfolio stabilizer. That's a different topic.
So equities allocation.
Sure.
Yeah. Yeah.
Well, if I may, before we move on to gold, I know you want to talk about it and we all want to talk about that, but before we move on now, when you're looking at stocks right now, Peter, are you very much a bottom-up investor? Are you looking at macro themes and top-down? Which countries are you looking at? Can you drill down a bit?
Yeah. First of all, I look at particularly the North American context right now. I see Europe as a very, very dysfunctional portion of the global economy. And I see the BRICS and other places that have good growth as very difficult to invest in most of the time. I feel Japan was a very attractive place to be owning stocks of. I'm a little worried by the valuations and the trend, which has been so long in one direction, largely only because they've cratered the currency over and over and over. So you had to hedge the yen to make money there. But I'm looking at the North American thing. Unlike most managers, I don't believe in this diversification stuff.
This theme keeps coming up, by the way. But go ahead, I agree with you.
Yeah. I mean, when we managed one of the world's largest gold funds for 11 years, which was called the Blanchard Gold Fund, we were the only gold fund that only had 20 positions. And this is how I feel about investing overall. My view is always, if somebody wants to be a good money manager and they can't pick 20 stocks that are going to outperform the market, or at least perform well in a market where maybe the index is going, thanks to the Magnificent Seven right now or whatever, is going ahead of major segments of the market, of the economy. If a money manager can't do that, he shouldn't be called a money manager, in my opinion. So we have relatively few stocks, typically 20 to 25 in a diversified portfolio, diversified in quotation marks. A core position for us is about 5%. Get your feet wet position is about 1.5%. And that's how we navigate. And in terms of sectors, really, we have very little diversification between different sectors. Right now, we feel in a good model portfolio, quite a bit of it has to be in stocks that are consumer staples. We've liked that. Some of the healthcare companies are defensive, others I wouldn't touch. I like commodities very much right now. So we've got oil stocks, copper stocks, uranium stocks, stuff like that. Those all look good. But that's about, it. And occasionally, and we look at each sector, and when things go into undervalued, under pressure territory, then we look more carefully at something that maybe we didn't like before. So finally, the thing is going back to valuations, and an outlook that we can accept. Utilities are a great example. So if interest rates really did come down, which we all feel is a good chance, I'd much rather hold utility companies in the portfolio than bonds. Much rather. Right? Because they typically benefit when rates go down. They have franchises that are untouchable to a large extent.
They have a moat.
So they have the moat, right? They pay good dividends. Much better than a bond, in my opinion.
Sure.
So I'm not sure I answered your question, but
you did, absolutely. And just on this diversification, Warren Buffett, obviously a great investor, says some great things. Don't agree with everything he says, particularly on taxes. But, he calls diversification, he said, is often an excuse for ignorance. And I think there's an awful lot to that. You know, people just diversify because they don't really know their companies well enough. And they think somehow they'll be protected by just diversifying.
Yeah.
No, I agree completely. And I think of John Templeton, you know, John Templeton, who's really my hero as an investor. You know, when he had the Templeton Global Fund, like from 1953 to when he turned it over to Franklin, it was the best performing global fund. He at one point, it was a global fund, but at one point he had 100% of the assets in the US, and at a different point he had 80% of the assets in Japan. So, you know, you don't have to be diversified everywhere to do well.
Yeah, I'm not a money manager, but I hear over and over again this concept that, you know, this idea of diversification to protect your assets is really a way to try not to fail. So as the money goes away because they've lost it all, but the returns aren't there because you're not playing to win, right? Where you're looking for the best alternatives to put the money to put it to work to get ahead for the investors. And I think you guys are both on target there, and other money managers I trust do the same thing. So I think we got a little confirmation bias there that's worthwhile listening to. So, before we skip on to gold, we're kind of in the middle of these two concepts, and I'll encourage anybody listening. Go ahead and type in questions. We'll get to them if they're on theme. If not, we'll get them at the end. Mardell went ahead and wrote in a period of stagflation, and the government wants CBDCs, central bank digital currencies. They can technically keep printing all citizens further into debt. What makes you think gold will come back as the monetary system? Do any of us think that gold will come back as a monetary system? Let's start there. And then what makes us think that?
I think from my perspective, I do not know the answer to that. I have never thought that gold would come back as the monetary standard if the United States and its allied economies had a say in it. Now, what may happen is that the BRICS bloc may force the issue. I'm not sure they will, but they seem to be setting themselves up for something that is backed by something, and as an alternative to the US dollar. That could force the issue. CBDCs are a completely different topic. I can't believe that I have no sense as to how many people will fall for this for the sake of convenience yet again. That seems to be the theme of our current decade, is convenience over wisdom.
Civil liberties go away in the blink of an eye.
It's just incredible, you know. And so they may succeed with this introduction of CBDCs. I have no doubt that the government will try to manipulate. But Adrian, you may have something to say about gold as the upcoming or future monetary system.
Yeah, no, I agree with what you said, and I can only think that if a reputable country like Singapore or a reputable group of countries were to have gold backing to their currency, it would become a very desirable currency. I can only think that. If I may just add something that was sort of in his question, but at the beginning, you know, gold, a lot of people think, well, why do I want to own gold when the economy is weak? And, the plain fact is, if you look at the empirical evidence, you look at the last 9 recessions that we've had in the US, gold has actually gone up I'm only looking at the period of a recession, gold has actually gone up in all but one of those. And the one that, when it didn't go up, was in the 1980s, when the European banks were selling their gold, dumping their gold before the gold agreement.
Getting what, $250 an ounce, I think back then England did.
Yeah, so that's a pretty good track record. And indeed, gold stocks, I will point out, went up in a majority of recessions, and in the ones where they didn't go up, they outperformed the S&P. So there's a very strong argument for having gold in a recession. And there's a pretty good argument for having gold stocks in a recession, and certainly gold stocks over the S&P. But that was a sort of tangent, if I may.
Yeah, I'll just kind of jump in on Delmar's question. I think it's hard. You know, we've got you don't have enough gold supply to back the supply of services and products and everything in the world for the GDP. Not one for sure. So I think, you know, at this point the price of an ounce of gold would have to be so astronomical. I do think the world is waking up to the fact that we need a responsible reserve currency. And we need a reserve currency that can't be questioned over time, right? So I think the weaponization of the dollar, that concept, the mismanagement of the dollar, even when it's not being weaponized, is leading all these countries, central banks, to go ahead and change the composition of their portfolios for their reserve currencies in favor of gold. I think the world is warming up to whatever is next from the dollar is got to be backed somehow in gold. I don't think it can be 100%. I think it would be partly backed in gold. I think it could be partly backed in gold, partly backed in other commodities like oil and grains and so forth, could be partly backed in other major currencies, and that can change over time, maybe a basket of commodities and currencies. And I think gold should be a part of that. I don't know if it could be all by itself, but I think the world's kind of waking up to gold as a part of this equation. So I
Oh,
think you're on target there.
yeah, yeah.
So, okay. Do we want to take further questions or move on here?
You're in charge.
Okay. Let's cover. We've got a couple more topics we want to touch on, so I'll go there first. Today, in this world, I mean, we see a lot of crazy valuations of virtually everything, right? We got the everything bubble. What today do you think are the most undervalued assets and why?
Well, I mean, to me, right now, the fundamentals, first of all, I think commodities are very, very undervalued. We've had a tremendous, and I start with the one that's least conspicuous, which is food commodities and fertilizers. They've taken a huge dump, and that's going to reverse. It has to. Corn is already making a little stand here. And there'll be more to come.
Sugar, yeah.
We have in the metal sector, we have this complete disconnect between, you know, here are our green targets with the EVs we have to have, and already the developed economies have backtracked on those targets that they set for 2029 originally. They're all saying, no, that's not attainable. We've been saying this from the very beginning, because I looked at things like the conductive metals, copper foremost. It's the cheapest, but there's also silver and gold. But when I looked at copper, what I could see right away is those targets, if they were even halfway reachable, we would need to add capacity to copper that is not realizable in the space of time that they designated. And if that capacity came on stream, the demand would be such that the copper price would have to go up, up, up. Then we have the disconnect with the ESG that came into being, which also depressed, for those who don't know what that means, environmental and social governance. It was kind of a new theme that was introduced, politically correct theme. And again, it was totally ignored that metals, mined metals, make up 42 or 43% of all manufactured goods. So, but it was suddenly, you know, unwholesome for anybody to invest in somebody who produced metals or a fossil fuel company, even though fossil fuels are needed to make the plastic and the fiberglass for the EVs, without which they couldn't, if they weren't, the EVs weren't much lighter than conventional metal body cars, then they couldn't carry that huge battery, right? So all those basic things were totally ignored by the market. So I think metals are a good place to be. And right now, looking at energy production and consumption, the real, and I know you had Lobo Tigre on your show a while ago. I totally agree with his analysis of uranium. The question is, excuse me, you want to buy a stock in uranium, and then it depends which one, or do you want to buy physical? Uranium is very unusual in that you can actually buy physical trusts that hold uranium, you know.
Can't take delivery. FedEx will not deliver, I'm pretty sure.
That's right. Yeah. Good point. Yeah. But uranium, copper, silver, I'm not too sure. It's an interesting proposition, and silver has a good track record in up markets of outperforming gold. But in the 70s, a lot of that was really also due to severe market manipulation. The Hunt brothers, all that stuff, which really boosted the ratio dramatically. And to what extent that would happen this time, I do not know, but silver is probably a decent bet. But there are all kinds of metals that look good now and are interesting. So the commodity sector looks good to me for the time being. What else is really undervalued? That was the question, right?
Yeah. And I agree with you, commodities across the board. Any others?
Yeah. And I'd be selective within the commodity spectrum. There are things like iron ore, which is not in any shortage situation for the foreseeable future, but they're companies that specialize or have tremendous exposure or tremendous resources in copper. Like, you take a Rio Tinto, for example. It's unbelievable what they control in the copper area in terms of reserves and develop properties that can be developed, and those stocks are starting to move quite visibly. Yeah.
So you made a good point there. I mean, when I look at the different metals in particular, but commodities generally, but the metals in particular, I want not only a good demand outlook, but I really favor the ones where, there just isn't enough of it. As you say, iron ore, there's no shortage of iron ore. Now there's clean iron ore and dirty iron ore and so on and so forth. But you look at something like copper, and as you said, even if we only get 50% of the demand expectations, we still simply do not have enough copper in the next several years. And the thing about copper, as you know, Peter, the thing about copper that is great is, the supply picture 5 years from now is pretty visible. There's not going to be a major copper mine, source of copper, that we don't already know about. Mm-hmm. So, you can look at, is this mine going to get permitted? Is Chile production going to continue to go down? But there's not going to be a major source of copper in 5 years' time that we don't already know about. And so you can do the numbers. You can look out 5 years and beyond with a high degree of accuracy as to what your potential supply will be. And the truth is, we just don't have enough to meet the anticipated demand. And of course, that means higher prices. So, yeah, I mean, I agree with you. I look much more at the ones where there's a potential shortage. And of course, when we say shortage, we're talking shortage at a price, right? As opposed to, say, iron ore, where there is no shortage. Rich, did you want to add something before I move on?
Yeah, just another question. Do either one of you think that oil at these levels is undervalued? And the reason I ask that is, let's face it, the world we live in, the world we know right now, with all this great explosion of opportunity and creativity and, growth and everything, production, is all done basis dinosaur juice. There's no two ways about it. You don't get this with windmills. You don't get this with solar power. And I've seen some estimates, and I don't understand why they're not hitting the mainstream, but I've seen some estimates that say that I want to say it's like 70 to 100 years it would take to mine the necessary materials it would take to make enough solar and windmills and everything to replace dinosaur juice. And that ain't happening anytime soon. It's not happening probably in 1 or 2 lifetimes. At some point, we've got to come back to oil. Is that underpriced right now? Is that an opportunity waiting to happen?
Well, I think a lot of it depends on the geopolitical game that is going on. A lot
What
of
are your
it
trends? Yeah.
depends on also you have the Middle East, and it seems to me that increasingly Saudi Arabia and the UAE and others, you know, the major oil producers in the Middle East are getting a lot. They seem to be much empowered compared to 5-6 years ago. When they talked about production cutback 5-6 years ago, they were very careful to placate the United States and then say it in the right way and maybe consider it for a while longer. And now I think it's like, okay, we're going along with the Israel thing. We're not saying too much about that, but on the oil front, we're going to damn well do what we please.
Yeah.
And this is the new theme. And so if that happens, and then the other thing, of course, is if I'm really right that the European economies are such a train wreck, and if we are right in assuming that the United States may be headed or may already be in the beginnings of a recession, then of course those guys will have to balance that situation again, the producers. So producer behavior is a key element. In terms of where we are right now, I think oil has upside potential.
Yeah.
I think natural gas has even more upside potential.
Good point.
That is completely, it's a curve I've never seen. You know, it's just straight cascade down from 30-40 bucks down to nothing, basically.
Because I thought that last year, Peter.
Yeah, exactly. And you know, you wonder how long can this continue? Of course, liquid natural gas has its many advantages in terms of transportation, compression, all this stuff, and you know, it doesn't depend on pipelines. It can very easily be shipped and so on, but it's undervalued dramatically at this stage. And so I would say oil and gas to me are more trading vehicles than just all out undervalued vehicles. But Adrian, you may have a totally different take on that. So I don't know.
No, I agree with you. I mean, you know, the difficulty is looking at, you know, which particular companies do you want to buy? Obviously, you can buy the big super majors, get a decent dividend, not get necessarily a huge amount of upside. I think the thing you have to be very careful about, as you mentioned earlier, is you want companies, particularly the exploration companies, you want to make sure that they have strong balance sheets. Because if this downturn lasts much longer, the downturn in the gas I'm talking about now, you know, a lot of companies with debt will find themselves in serious problems. Yeah.
Okay. So sorry to take us off on a tangent. I will say there are a couple questions about gold, but I know Adrian's going that direction next. So let's go that direction. And then if we don't answer those questions, we can bring them up after in the Q&A.
Okay, well, let's just talk gold, Peter. You've talked about the gold as a diversifier in a portfolio, but let's talk about gold as an investment, gold versus gold stocks, gold versus silver, platinum. You were the first person that told me about platinum, actually, palladium, actually. Never heard of palladium before you told me about it. And then let's look at gold stocks. How do you see the gold stocks right now in this scenario versus bullion? Do you like the royalties, the majors? etc. Just talk to us about how you're playing gold.
Okay, well, with gold first, the big disconnect with gold is this issue that everybody talks about. How can the gold price be up when the dollar is up, right? And to me, that is almost logical that that is happening with the BRICS evolution and all this stuff. Why? Because, again, when I grew up in the 70s as a young trader and throughout the 80s, every day, the only thing that mattered for gold was the London gold fixing. Gold was all centered on London, England. And what happened in the United States was of secondary importance. And then the emergence in the 1980s of the ETFs and the gold funds changed everything. All of a sudden, this massive capital base allocated to gold was centered on the United States. And so everything that mattered to the gold price emanated from the United States. And the World Gold Council looks at what are the ETF inflows or outflows. We're experiencing a changing of the guard again right now. When you look at where does the demand come from in the last few months, the critical few months in this gold rise, it comes from China, it comes from Turkey, it comes from Russia, it comes from the thing I talked about earlier, the BRICS, the Shanghai Cooperation Organization, also some private interests, not just central banks, in places like the United Arab Emirates, which seems to be the incubator of all interesting things these days. The UAE, a very, very exciting place in a financial sense, less so in other ways. But so basically, what you have is, and this also speaks to the underperformance of gold stocks vis-a-vis gold, especially in the first leg of this movement. So in the United States, you really did not have much interest in gold per se. And therefore, the same people who live in the United States didn't have much interest in gold physical, by extension, also don't have much interest in gold stocks. So therefore, gold stocks were not a favored category. In the BRICS nations, there is no big market for gold stocks. They just know physical. So physical went up. And now let's talk about the dollar. So why was the dollar up? The dollar is being dumped by the BRICS, we all agree, but the dollar is still kingpin in the traditional, what we call the West, the developed economies. Why? Because the central bank policy rate on the US dollar is much higher than that in Europe, in Japan. It's even higher than the one in Canada, which is fairly high. It's higher than the one in Britain. So all those people are still gravitating. Capital is moving or staying in the dollar. Some new one is moving toward the dollar from that side. And, that right now is larger than what is being dumped by the others. And on gold, it's the reverse. So you have this situation, this dynamic where gold has really a new head office. It's called the non-developed world, the non-developed economies.
The developing world, right?
The developing world, yeah, rapidly developing world, and they have this huge incentive. And so that's how I see it. In terms of gold stocks, what do I like? I have a bias toward physical gold, number one, because it's already a major portfolio component for us. But we do in our model portfolio have some gold stocks, and typically in the past 2 years, those have been 1 or 2 positions in the big names, in the go-to stocks. Because when the big money moves, it's not going to move into the juniors. it's first going to move into those big stocks. And
Right.
you've seen that in some names. And then there's some outperformers in the middle range. One of the companies I was a co-founder of is doing particularly well right now because cash flow is really expanding rapidly. That's Dundee. But the big names, you mentioned Adrian, and I really should turn to you because you're the gold stock man. I'm the physical man, but in gold terms. But do we like the royalty, the streaming companies a lot? We had in the model portfolio the streaming companies during the period before we could see evidence of interest in gold producing stocks, gold mining stocks. And now we are de-emphasizing our exposure to the royalty companies. And we think the producers are going to be more interesting for a little while. And as you know, there's some that have a longer term model built in, specifically Barrick, and others that are reaping major cash flow gains already now. And so that's kind of how we see it. What do you think?
Yeah, I mean, I agree completely. At the beginning of well, first of all, you know, there's that saying Rick Rule likes to say, don't buy hamburger when the filet's on sale. And I mean, right now, the major companies are very, very undervalued. So that's one reason, you know, and a disconnect in valuation between the gold price and the leading miners is very broad. So that's one thing. But the other thing, as you mentioned, is that's where the money will flow first. The major companies will be the first to move. And not only will they be the first to move, but they'll also be, equally importantly, I think, the more certain to move. So you could buy, for example, Agnico, Barrick, Newmont. I'm not saying I like all these, but the three largest miners and Wheaton and Franco, the two largest royalty companies. And as close as the SEC will let me guarantee anything, I will guarantee you that if gold goes to 2,500, those five stocks will do well. Mm-hmm. You could buy Consolidated, Moose Pasture, and Amalgamated, Ajax, and everything else. They may or may not do well. They may have more potential, but they may or may not do well. So I agree with you 100% to stick with the seniors. I'm a little, maybe I differ from you a little bit on the royalties. I certainly wouldn't dump the royalties. The royalties, you know, they do have leverage to a higher gold price, as you know. Mm-hmm. And part of that leverage, of course, comes from expansions of mines on which they have streams and royalties. And the royalty companies, the stream, as you know, 30 years ago, most of the royalties were legacy royalties, but you purchased from an owner, not from the company. And so the perimeter of the scope of your royalty was already defined for you. Right now, when companies are creating royalties and streams from exploration and development companies, the royalty companies are very, very careful to make sure that their royalty encompasses the potential expansion of the mine. And so when companies do expansions, they do greenfields, brownfields exploration, and they produce more, that all accrues to the royalty and streaming company. And of course, those companies don't have to pay any more money for it. So I would argue that the royalty and streaming companies have considerable leverage to a long, sustained bull market in gold, perhaps in a way that they didn't 30 years ago. Yeah, anyway, do you have some questions, Rich? Oh, sorry,
Yeah.
Peter, go on.
Go ahead. You want to add to that, Peter?
No, I was just going to make one more comment, Adrian. Absolutely, I agree with you. You know, I was talking about a diversified portfolio, which has maybe one, maybe two positions in gold. And you are talking about a portfolio that has a far larger inclusion in the gold sector. And so,
Sure.
yes, definitely in your position, I would include some of the streamers. Again, the large ones and not the smaller ones mostly, but they, and they do have leverage. I don't dispute that. Yeah.
Yeah.
All right. So Walter asked, how do you get rid of the gold paper traders who move the price of gold as they choose? How do we get rid of them?
That's a really, really brilliant question. That's, how do you get rid of them? Well, I have a few scenarios of how we can do that, but that's not going to happen.
Let's keep it
But
legal.
the real issue is really what side are they on now? A lot of those guys have been hurt badly. And, there's no question on my mind that something that trades in terms of market capitalization through futures, options, derivatives, all kinds of things to the tune of many multiples of what is available above ground in physical gold in the world, that can have an influence. This, by the way, is what I always say to the people who say the Bitcoin universe is limited. No, it's not. The minute Goldman Sachs and JP Morgan and everybody else comes out with derivatives, that's going to have an impact on the price. And that is true of every commodity, every asset class. If you populate it with other vehicles, then the actual fundamentals of the underlying asset is manipulated by definition.
Yeah.
But I think, it's been coming for some time. The people who were shorting gold that they didn't have through various vehicles did very well for some time.
Yeah.
And then came the moment of truth when all of a sudden, and I think they're terrified right now because how do you rise against the kind of Chinese 27 tons in the first quarter of this year?
Yeah.
How do you win on the short side against something totally unknown like that? It could have been 50 tons. It could have been only 15. You just don't know, right?
Yeah.
And so manipulation tends to be in markets that are arranged between a number of players, where guys have coffee together after trading hours and talk their book and stuff like that. And that's become very hard to do right now.
Yeah.
Adrian, any
No,
thoughts?
I agree with that. And it's so much easier. It's so much easier to short markets that are fragile, and maybe you win because the market sort of wants to go down anyway. But I think in a market like this, trying to suppress the price will be very, very difficult.
Okay. I don't have much more to add to that. The bottom line is my belief is I still believe in free markets. And I do think every market is manipulated. I think the biggest manipulator on earth is the Fed. They affect more markets with their manipulations than anybody else. But in the end, I think supply demand takes over. The will of the people will take over. If somebody's going to buy something, it will have an impact on the supply demand fundamentals. Period. So Donald asks, unprecedented debt that you mentioned will obviously take a long time to resolve in some way, if ever it can be resolved, by the way. You also mentioned that the move in gold is at least partly due to the debt issue. Do you then see a years-long rise for gold as the debt issue problem continues on? If I could, I'll just start off here, and if you guys want to add to it, but I think we've seen a years-long uh, increase in the gold price. I mean, don't look now, but gold's up 600, 700% since 2000. Now I know there was a bull market in there, but we also had a retraction, and now it's rising again to new all-time highs. The if you get caught up in the short term, you think gold hasn't been doing its job. If you zoom out, you can see that gold has steadily been moving up in value because of the debt issue. The only way the government can deal with debt is they expand the money supply, which is called inflation. It affects the prices of everything that matters, and the gold price is not exempt from that. It has been moving up steadily since we decoupled it from the dollar. and no longer had a fixed price. The wheels fell off of the cart at that point, and gold just took off. And until we resolve it, I absolutely expect that to continue. I don't see any will by Congress to resolve it at all. So I think that's going to continue for some time, and I can't promise it. SEC is not going to come after me if I promise that gold price is going to go higher. I don't see how it can go down long term. Day to day, sure, but long term, how can it when it's measured in mismanaged fiat? I don't know if you guys want to add to that, jump on the soapbox.
No, I agree with you 100%. And you made one good point, and Peter made it earlier. There simply is no will, whether it's in Congress or in many countries around the world, in the West. There is simply no will to get the fiscal under control. I mean, they just came out with another report on Social Security. They issue it every year, telling you that the Security Trust Fund is going to go bust within a certain number of years. And what does Congress do about it?
2033.
And what do they do about it? They attack people who say we need to do something, we need to fix Social Security, and those people get attacked as one. So, there's America has. Was it Churchill who said America always does the right thing in the end after they've tried everything else?
Yeah.
I don't know who said it, but we'll say Churchill. Was it
as good as any?
But America certainly has a long record of waiting before they tackle important issues. And I think we need a crisis before America will tackle the fiscal issues, particularly Social Security, Medicare, Medicaid, and so on.
Yeah. Peter, any thoughts there, or no? Nothing to add to that?
I have nothing to add. I agree totally with what both of you said. Yeah.
All right. Bill has a question. Says, sorry, several related questions with sound money themes. So I'm going to go through this fairly quickly, but I think you'll see where he's going. Does an argument exist that is against sound money? I think we see that every day with the dollar. But if one exists, does that argument make sense? If it makes sense, then why does our current Western monetary system not make sense? And then if the way we run our systems does not make sense, why is our money not sound right now? Are people, banks, powers that be allergic to sound money, not backed by gold, silver, other commodities, et cetera, because they cannot manipulate and steal from depositors, politics, and the market at large? So a lot going on there. I kind of want to answer it with yes, but I'll let you guys go first here, and then I can give you some thoughts if you want to. Peter?
Well, I mean, trust in money and to guess how long it lasts and where it ends is futile, because I gave up a long time ago to outguess the psychology of the crowd. When I do that, I'm always wrong. I would have thought that people would lose faith in money quite some time ago, and they haven't. So how long can this model be pushed forward? I do not know, but there are consequences to doing what both the monetary and the fiscal authorities have been doing. And the most notable one is inflation. Now, you have inflation right now according to the US Bureau of Labor Statistics, CPI is 3.5% right now.
Apparently they don't buy groceries, but yeah.
And what's really amazing is that every economist and every government operative justifies their actions based on that number. Well, we all know that that number is utter nonsense. You talk to any citizen at any level of consumption, nobody will agree that inflation is at that level. We all know better, right? But for some reason, because the government says it's this, and the media echoes that right across the board, and Jerome Powell says it, and this guy says it, and that guy says, all the talking heads, it's accepted. And so, at one point it's not. And what I would say to your listener who asked these questions is, look at monetary history. There is in monetary history not one example where what is happening now, right here, did not eventually collapse. And the collapse has horrific consequences at all levels of society. In the end, there aren't very many parties that benefit from it, you know? And that's all I would say is monetary history says it will end if it continues in this way. And if they counteract it and they pull a Paul Volcker or whatever, we're going to have a long, long moment of correction that is extremely painful. It's called depression. Those are the two options. Adrian, to you.
Yeah, no, absolutely. I mean, I agree with everything. We could talk about this all night as well.
Yes.
But the question has started by saying, is there an argument against sound money? Yeah, yes, there is. It's called modern monetary theory, which is just
What do you call
nonsense
that,
on
Adrian? The
still.
magical mystery money tree, or what do you call that?
The magical mystery tree, yeah. It's nonsense on stilts. It's a theory, if we can call it a theory. The thing about modern monetary theory is it's neither modern, nor is it monetary, nor is it a theory, like the Holy Roman Empire. Because it's been tried, as Peter alluded to, it's been tried throughout history. It's basically a way of thinking that you can create something from nothing. That's what modern monetary theory is. And sound money is the opposite. You have to have discipline. Sound money means that people have an incentive to save and to invest. If you have modern monetary theory or any variance of it throughout history, there is no incentive to invest and to save. The incentive is to get rid of your money as soon as your currency, I should say, because there's obviously a difference between money and currency. To get rid of your currency as soon as you can, such as we see in Zimbabwe, where you go into a restaurant,
Argentina.
you go into a restaurant and you actually pay your bill at the beginning of the meal because it will be higher by the time you leave.
Yep.
You get paid, you don't take your money to the bank and deposit it, you spend it as soon as you can. And that means people don't save. And if people don't save, they can't invest. So there's no capital investment in these countries, in these scenarios. And I think when you look back at history, we could look at Rome, we could look at lots of periods in history. But one interesting period of history might be the middle to the late 18th century France, where you had John Law, who came over from Scotland, and he instituted what was in effect modern monetary theory. Creating credit and currency out of thin air. And you had all the speculative bubbles, the South Sea bubble and so on, all of those things in that period. And then how did that end? Well, how did it end for the king and how did it end for the aristocracy? They got their heads cut off. But how did it end for the middle class? Not very well at all. You had 40 years there of devastation, ending with dictatorship. I hope the French people will excuse me if I call Napoleon a dictator, and war, 20 years of war. So it didn't end very well. And these periods do not end well. They have not just monetary consequences, but they have military, societal, political consequences as well.
Yeah, I'll just add to that. I can't argue with anything. The problem here, I see the decline, right? So we talked about the U.S., this whole period, the U.S. being a dominant military power worldwide. That's why we get to impose our will on this, that, and the other. You're only a military power worldwide if you're first a financial power worldwide. And what we're seeing that financial power decrease clearly and rapidly before our eyes because of mismanagement. It's not long before we will no longer be the dominant military power. That's the way things work. We've seen this play out time and time and time again through history. So the problem here is you got to get people motivated to make the changes that we all know are necessary. But who's going to do that? We're in a system where you want to be elected and you want to get elected over and over and over again. You want that to be your entrenched career path, and you're only going to get elected if you promise people stuff. And it doesn't matter if you can pay for it or not. You just got to promise it to them, because nobody's going to take that hard pill. Instead, they're going to take the little mild pill that says everybody is going to pay a little bit for what we're spending money on through inflation. Okay. As opposed to taking that bitter pill and then instituting sound money practices. So I don't see it getting resolved until we see term limits, until we see people getting serious about fixing the economy. The alternative is where we're headed, and we've seen it before, and that is going to be the loss of reserve currency status, which most people just can't wrap their heads around. Just understand that your what am I trying to say? Your life, your level of living, your standard of living. Thank you.
Standard living.
Yeah, it is just going to diminish incredibly. You're not going to live the life you're living right now. You're going to live a very different life, and you'll get used to that, and it'll be fine. You're not going to disappear off the face of the earth, but it's not going to be the same. You're not going to enjoy it as much. I promise you. So.
And you already have that. I mean, the basic contraction of the middle class in the United States is the theme of the last 25 years. I remember writing in my earlier newsletters a long time ago how the United States had this vibrant, huge middle class, and we scoffed and laughed about countries like Brazil, where a few owned everything and the rest of the nation was impoverished, you know?
Yeah.
And you look at the United States now, which has one of the smallest middle classes in today's developed economies. That is a gigantic change, and that is not a change that would be lost on the populace if it weren't for debt. The only reason the standard of living has not cratered completely in the United States is because debt has been so readily available. But you look at the average rate on credit card debt now, which is in the somewhere in the mid-20s.
I think it's 28.5 I saw today.
Yeah, 28.5%. And, you know, people in the upper middle class look at the rate they pay and they say, well, I'm not paying that. Well, that's because they're prime credits. But that's the average, 28 point something percent. And how long is that going to happen, you know?
It's getting close.
Yeah.
Just a couple comments here. So Bill thanks. He says current system needs to be raised. Your current monetary system needs to be raised. Y'all are awesome. Monetary theory is garbage. People will, and sound money is the only way that makes any sense. Thank you all. I'm not crazy after all. No, you're not at all crazy. Another Bill says our currency has been debased. 100% agree. Eric, just a quick note, own nothing and you will be happy. I think he's echoing the World Economic Forum, and none of us want to go there. And then the last question here before we're going to wrap things up is Clifford came in and said, what about investing in Neptune, gold, silver, platinum, and palladium, by the way, Cliff? So I'll probably take that one. There's a pluses and minuses, okay? So I think he's referring, if everybody's aware, Neptune Global. So they produce the precious metals composite, so the PMC, which is, it's not a coin, but it's a holding of a 1 ounce made up of a portion of gold, a portion of silver, a portion of platinum, a portion of palladium. And it's kind of like quick divisibility, lets you get into the market. We offer it for Neptune Global. We're one of their dealers. I like it as a quick divisibility, a way to own all 4 precious metals in a I guess a composition that has worked over the years. It has outpaced any individual metal over the period of its existence. And the idea that Chris Blasey had behind that was to kind of make it in a more digestible form, you know, for most folks looking to buy things that are used to stocks or mutual funds and what have you, to own precious metals that are physically stored. So it's another good option, but that's that diversity versus do you want to focus your efforts, right? So you have to weigh that out yourself. I don't think anybody wants to add to that, but it's available if you want to. We can offer that for you. So at this point, I kind of want to go around the table and say, all right, if you're going to leave everybody just with one last important thought, you know, this is what you want to remember tonight's conversation about. What would it be? And then also take the time to let people know how they can find you, because you all have great insights and people need to hear more of them. So I want them to be able to connect with you. So maybe start off with Peter.
Well, I would say again, don't bank on one outcome. Uh, don't subscribe to confirmation bias. We all are tempted to do that. It's the easiest trap to fall into. Be prepared for many outcomes and adjust as things happen. Out outguessing the crowd is not a very good tool in investing. That's what I would say. Be flexible.
All right. How can people reach you? I know you got a fantastic newsletter. People can hear your insights, not just tonight,
Oh,
but ongoing. How can they reach you, Peter?
yeah. So we have a free newsletter. We don't sell anything, and the newsletter is available by subscription on our website, which is cavelti.com. That's all you have to do. And then you go under research and there's a subscription protocol, or you can send us an email. Our email address is on the website to cavelti.com.
Sounds great. And everybody should absolutely do that. I read it religiously. It's great stuff.
Yeah.
Adrian.
Well, I like what Peter said, but also revert, if I may, to something we were talking about at the beginning of this conversation. Obviously, you don't want to put all of your eggs in one basket, but overly broad diversification just for the sake of diversification is not a good idea either. You need to have, once you've gone past your top 10 conviction stocks, you are generally adding lower conviction, which means you know less about them and you believe in them less. One of the tests to me, and I'll finish with this, one of the tests to me of how strongly I feel about something is when a stock or a sector goes down, am I happy that I can buy more at a better price, or am I unhappy? And what I found is that when stocks go down, my immediate reaction is, oh, good, I can buy more. It generally means that I know the stock, the company a lot better, and I understand it a lot better. If I don't know something well, then obviously, I'm hesitant when it goes down. So don't over diversify would be another message. And people can get my stuff. My newsletter's not free. I'm really sorry. We are happy to send a sample, but adrianday.com told you about the newsletter on the money management.
Yeah, and we take advantage of both, and they are both worthwhile. I highly encourage everybody. If you're looking to own a portfolio of international stocks, mining stocks, etc., you got to go. You got to go to Adrian. I mean, reach out to him. Trust me, we've been with him for many years. And I want to go on that theme. So you talked about when things go down, how do you respond? And you're going to hear this from me time and time again. Obviously, I'm the gold guy. I'm going to talk a little bit about gold. I'm going to talk a little bit about silver. You're going to hear me say this over and over again. I've been saying it for a year or so now. Gold at all-time highs is dirt cheap. Make no mistake about it. Silver at half of all-time highs is even cheaper, in my personal opinion. Gold consolidated for 4 years, and it didn't do that at all-time highs to go lower. It did that at all-time highs to build the support to go higher, and that's what we're starting to see now. This $100 pullback in the last month is an opportunity to buy well. Embrace it, okay? Silver got much more upside potential from a profit standpoint. I love gold for wealth insurance. I love silver for the profit potential, and it's got a long way to go. Embrace this to $2.50 pullback in silver from 29 and change to 27 and change. It is absolutely worth it. The way to take advantage of that, if you want to know how to reach us, just reply to the email we're going to send you yesterday with a full recap of this webinar. We're going to send you the link so you can watch it again over time. In it, you'll have contact information for Peter, for Adrian, and for us. For those that want it now, it's infoasi at assetstrategies.com. And I want you to buy gold. I want you to buy silver. We have a great deal for those on the webinar that want to call in tomorrow. We're selling 1 ounce gold K-Rands, the first minted coin. We know the father of the Krugerrand, Don McKay Coghill. He launched that program out of South African Mint. We're offering backdated gold Krugerrands plus $49. Great price. So $49 over gold spot. 1 ounce silver K-Rands, 2023s at $2.49 over spot. Compare those prices anywhere and then call us, and we're happy to take advantage of you. And Eric Lemieux says, great discussions and merci. And I just want to say, Eric and all those that attended, merci. We appreciate you.
Bonsoir, Eric.
Yes. And Peter, thank you so much for joining us. I know you brought value, and I appreciate you being with us tonight. And Adrian, as always, thank you.